Welcome to The Explainer. Today, we're diving deep into the DNA of our economy by looking at different market structures. We're going to explore the two big roles any business can play, being a price taker or a price maker.
So let's kick things off with a little puzzle. Ever wonder why a wheat farmer just kind of looks up the going rate for wheat and sells at that price? No questions asked? But then a massive tech company that makes a new smartphone gets to decide exactly how much you're going to pay for it. What's behind that huge difference in power? Well, it all comes down to the structure of their markets.
Okay, so this whole thing really boils down to two key ideas. On one side, you've got the price taker. They're in a market where their product is pretty much identical to everyone else's, so they have no choice but to accept the going price. Then on the other side, you have the price maker. Because they're selling something that's unique or at least different, they get to influence or sometimes even just set the price. This one distinction, it's the key to understanding everything else we're about to talk about.
Let's start at one extreme end of the spectrum. Imagine a world filled with nothing but price takers. This is what economists call the ideal of perfect competition. You can think of it as a kind of theoretical baseline that helps us make sense of all the other, messier market types.
So what exactly is it? Well, perfect competition is a market where you have a ton of small firms, and every single one of them is making an identical product. The classic example you always hear about is agriculture, right? One farmer's bushel of wheat is, for all intents and purposes, the exact same as another's.
Now, for a market to actually be perfectly competitive, the conditions are incredibly strict. I mean, you need tons of buyers and sellers, an identical product, everyone has to know everything, there are no extra costs, and companies can jump in or out of the market whenever they want. It's pretty much a theorist's dream, which is exactly why it's so hard to find a real-world market that checks every single one of those boxes. And this right here gets to the absolute heart of being a price taker. For any single company in this market, the demand for its product looks like a perfectly flat, horizontal line. And why is that? Because they are so tiny compared to the whole market that they can sell as much as they want at that one market price. But if they try to charge even a penny more, nope. Buyers will just instantly go to one of the countless other sellers.
So if you can't pick your own price, how in the world do you decide how much to produce? The rule is actually really simple and kind of beautiful. You keep producing right up to the point where the price you get, that's P, is equal to your marginal cost, or MC. That's just the cost of making one more unit. If you produce any less, you're leaving money on the table. If you produce any more, every extra item is actually costing you more than you're making from it.
So here's where that free entry and exit rule really kicks in. If companies in this market are making a nice profit, other entrepreneurs are going to see that and say, hey, I want in on that. They jump into the market, which increases the total supply, and that, in turn, pushes the market price down. This just keeps happening until all those extra profits get competed away and firms end up making zero economic profit. Now, that doesn't mean they're broke. It just means they're covering all their costs, including what they could have earned doing something else. Okay, time to do a complete 180. Let's swing to the total opposite end of the spectrum. Forget about thousands of tiny firms. Let's talk about a market with just one. This is the world of the ultimate price maker, the monopoly.
A monopoly is pretty much exactly what it sounds like. It's a single company that is the only seller of a product that has no good alternatives. For that product, they are the market. And as you can imagine, that gives them a whole lot of power.
So how does a company get this powerful? Well, a lot of times it's because of huge economies of scale. It's just way cheaper for one giant firm, like your local water company, to serve everybody. Other times the power comes from the government, through things like patents. Or maybe they just have a secret sauce, some unique cost advantage that no one else can replicate.
Now, this is a really important shift in thinking. Remember that flat demand curve for the competitive firm? Well, forget it. A monopolist's demand curve is the entire market's demand curve. And what does that look like? It slopes downward. If they want to sell more of their product, they have to lower the price. This totally changes the rule for maximizing profit. A monopolist produces where its marginal revenue, or MR, equals its marginal cost, MC. Now, marginal revenue is the extra cash you get from selling one more unit. And since they have to lower the price on all their products just to sell that one extra one, their marginal revenue is actually always less than the price they're charging. So here's the bottom line. When a monopolist produces where MR equals MC, the price it ends up charging us, the consumers, is always higher than its marginal cost. That gap right there between the price and the marginal cost, that is the purest expression of a monopolist market power. All right, so we've seen the two extremes. Perfect competition on one side, pure monopoly on the other. But you know, most of the markets we deal with every single day live somewhere in the middle. And that brings us to the most common market structure of all, monopolistic competition. Monopolistic competition is this really fascinating hybrid. Just like perfect competition, it has a lot of firms and it's easy to get into the market. But like a monopoly, each firm is selling a product that's just a little bit different from everyone else's. Just think about restaurants or coffee shops or clothing stores. They all sell similar stuff, but each one has its own unique spin. Let's just put these three side by side for a second. You can see the pattern really clearly, right? Perfect competition, tons of firms, identical products, zero pricing power. Monopoly, one firm, a unique product, tons of power. And then, smack in the middle, you've got monopolistic competition, many firms, but with differentiated products, which gives them some pricing power. They're definitely price makers, just on a much smaller scale than a true monopoly. So, in this kind of market, the name of the game is product differentiation. The entire goal is to convince you, the customer, that my product is different from and better than the competition's. And this is where things like branding and advertising become absolutely crucial. And how do they pull this off? Well, they've got a whole playbook of strategies. They might use comparative advertising, like the classic cola wars, to point out how they're different. Or they'll spend millions building brand equity, that special something that makes you willing to pay more for a brand with a certain logo. The goal is always the same: carve out their own little mini market in your mind.
And here we see that hybrid nature pop up again, just like in perfect competition. That free entry means any short-term profits get competed away pretty fast, leading to zero economic profit in the long run. But, and this is a big but, because their product is still a little bit different, they hang on to a tiny bit of pricing power, so they continue to charge a price that is greater than their marginal cost.
Okay, so we've run through these three big models. But why does any of this actually matter to you? Well, because these structures are quietly shaping almost every single economic choice you make every single day. So let's just put it all together on one cheat sheet. The key differences really come down to pricing and profit. In perfect competition, the price equals the cost of that last item made. It's super efficient for society. On the other end, monopolies can keep profits high forever because no one else can get in. And monopolistic competition? Well, that's the big trade-off. We pay slightly higher prices, but in return we get all the choice and variety that we love. And really, that's the big takeaway here. The structure of any given market is what directly determines the prices you pay, the number of choices you have on the shelf, and even the incentive for companies to innovate and create the next big thing. So, we'll leave you with this question to chew on. We tend to think that more competition is always better because it means lower prices. But the chance to earn those big monopoly-like profits can be a huge driver of innovation. So, what do you think is the perfect balance for a healthy economy? Thanks for joining us on The Explainer.